Although $70-80 rebound in gold prices from the low of 1180 has been impressive, the broader trend in gold prices seem to be fragile. Flow of better macroeconomic numbers from US has reinforced the expectation that US Fed will eventually scale down the bond buying programs in the coming months. Market focus is accentuated on the US employment report as it can influence the current price trend in the precious spec. If the job number exceeds the expectation of 1,65,000 jobs, we could see a sharp sell-off in gold prices, while figures lower than the forecast will lead to an inference that the Fed may not start the tapering immediately. On the base metal outlook, we believe that on the fundamental side, things are not inspiring in most of the metals as we have expanding supply and expanding global surplus and rising LME warehouse stocks. The macroeconomic trend in China is also not supportive for the industrial commodities, which is exhibited by dipping PMI and manufacturing surveys. Copper prices have failed to surpass $7,000 per ton, and there is an absence of any strong demand impetus from China. We believe that copper prices have topped out at the current levels, and we cannot rule out the possibility of prices retesting the low of 6,600 on the LME. On the energy front, we believe that crude oil prices are well poised to witness a short-term upside. Turbulence in Egypt is actually acting as an impetus for the oil prices. Although Egypt is not a significant producer of crude oil, but Egypt controls the Suez Canal, which is a key shipping route for global oil trade. Suez Canal accounts for the transportation of literally 8 lakh barrel of crude oil and 1 million barrel of refined products per day. Such developments would actually continue to provide support to the prices, and prices are expected to test 103.5 in the coming weeks.